Hi, hope you're doing well. This is the part of venture debt that catches almost every first-time founder off guard. So let's slow down here. Venture debt isn't just an interest rate. Lenders boost their overall return, their IRR, through something called warrants. A warrant is the lender's right to buy a small slice of your equity later, at the valuation of your last round. Think of it as the lender saying, I'll lend you money at a reasonable interest rate, but in exchange, give me the option to also participate a little in your equity upside in case this company turns out to be the next big thing. Let's work through the numbers. A company borrows $2 million with 5% warrant coverage. That means the lender gets the right to buy $100,000 worth of equity, priced at your last round's valuation. If your company's valuation later grows 10 times, those warrants suddenly deliver a meaningful upside kicker for the lender. They've essentially blended a fixed income loan with a small VC-style equity bet. On screen, you can see the typical ranges: 12 to 15% annual interest, 1 to 5% warrant coverage as a percentage of the loan, and 3 to 6 months of typical runway extension. Here's my honest advice. Warrant coverage is negotiable, and most first-time founders don't negotiate it at all. They just accept whatever the lender proposes. If you have any leverage, competing term sheets, strong revenue, an existing relationship with the fund, push on that warrant percentage. It feels small at signing. If your company does well, it stops feeling small very quickly. Alright, let's put everything side by side, because I want you to have a mental checklist you can actually use. Look at cost of capital in the success case. Equity is extremely expensive because that dilution is permanent, while venture debt is low to moderate, just interest plus those minor warrants. Now flip it. Cost of capital in the failure case. Equity is zero because your investors absorb the loss if the company doesn't work out. Venture debt is high because the lender can move to liquidate assets, including your IP, to recover what they owed. This is the fundamental risk transfer trade-off underlying this entire decision. Next, cash flow impact. Equity is positive, it injects cash with no outflows. Debt is negative, it requires interest and eventually principal payments. On control and governance, equity is high friction, board seats, veto rights, while debt is low friction, no board seats, just standard reporting requirements. And then prerequisites and use case, which I think are the most practical rows on this whole table. Equity requires a compelling vision, team, and total addressable market. It's a bet on potential. Venture debt requires existing VC backing and predictable revenue or metrics. It's underwritten on evidence, not potential. That single distinction tells you almost everything about which stage of company each tool is built for. I genuinely encourage you to screenshot this table. When you're in a term sheet negotiation and things are moving fast, having this framework in your back pocket will help you ask sharper questions instead of just reacting to whatever's put in front of you. Thank you so much for watching the video till now. Next part will be released in the coming week, so tuned in and take care.